calls, puts, strike prices, premiums, implied volatility. If you've ever heard someone talk about options trading and felt like they were speaking a completely different language, you're not alone. That was me too. But here's the thing. Once you understand what an option actually is, not the jargon, not the strategies, just the basic idea, everything else clicks into place. And that's exactly what we're doing today. Welcome back to Sense and Commas, where we make money make sense. Okay, so what is an option? Let's start there because honestly, most beginners skip this step and then wonder why nothing makes sense. An option is a contract. That's it. It's not a stock. It's not ownership in a company. It's a contract that gives someone the right, not the obligation, to buy or sell shares at a specific price before a specific date. Real quick, let us break that down. There are two types, call options and put options. Let's start with calls. A call option gives you the right to buy a stock at a specific price. People buy calls when they believe a stock is going up. Let's say a stock is trading at $100. You think it's going to rise over the next month. Instead of buying the stock itself, which might cost you $10,000 for 100 shares, you buy a call option. If the stock rises to 120, your option may increase in value because it gives you the right to buy shares at the lower price. That's buying a call, a bullish bet. Now, put options. They work in the opposite direction. A put option gives you the right to sell a stock at a specific price. People buy puts when they believe a stock is going to fall. Same scenario, stock at $100. You think it's dropping. You buy a put option. If the stock falls to 80, your put may increase in value because it allows you to sell shares at a higher price than what the market is currently offering. So calls are generally bullish, puts are generally bearish. Makes sense so far, right? Now here's where it gets interesting. So far we've talked about buying options, but what about selling them? This is something that confuses a lot of beginners. Most people hear about buying calls and buying puts, but many experienced investors actually spend more time selling options. Why? Because when you buy an option, you pay a premium. When you sell an option, you collect a premium. Think of it like insurance. Let's say you pay for car insurance. You're the buyer. You pay a premium every month. If nothing happens, great. The insurance company keeps your money. If you get in an accident, you're covered. Options work the same way. The buyer pays for protection or opportunity. The seller collects that payment and takes on the risk. That's the trade-off. And now you understand why some people prefer selling options. They're the insurance company in that equation. Now here's something I want to be straight with you about. This does not mean selling options is safer. It just means the incentives are flipped. So what does selling options actually look like in practice? Let's look at two strategies you'll hear about constantly: covered calls and cash-secured puts. A covered call is when you already own 100 shares of a stock, and you sell a call option against those shares. You collect a premium, just for agreeing to sell your shares at a certain price. If the stock never hits that price, you keep your shares and the premium. If it does, you sell your shares at the agreed price, which you were okay with anyway. A lot of long-term investors use covered calls to generate extra income from stocks they already own and plan to hold. Then there's the cash-secured put. This is when you sell a put option while keeping enough cash available to buy the stock if you're assigned. Investors use this when they wouldn't mind owning a stock, but at a lower price. They sell the put, collect a premium, and wait. If the stock never dips to the strike price, they keep the premium. If it does, they buy shares at a price they were willing to pay anyway. Think of it like placing a limit order, but getting paid to wait. Now let's talk about a few terms you'll hear all the time. Because once you understand these, options stop feeling like a foreign language. In the money, out of the money. These just describe whether an option currently has value based on the stock's price. Don't let the terminology scare you. It's just a label. Implied volatility. This measures how much movement the market expects from a stock. Higher implied volatility means more expensive options. Lower means cheaper. Think about insurance again. Right before a hurricane, insurance gets more expensive. Uncertainty goes up, premiums go up. Options work the same way. But here's what every beginner needs to hear. Options are not magic. They're not a shortcut to getting rich. And I want to be straight with you. They can be riskier than simply buying and holding stocks. Many options expire worthless. Some strategies can expose you to significant losses if you don't fully understand what you're doing. That doesn't mean options are bad, it means they're tools. And like any tool, they're only as safe as the person using them. Now, before we wrap up, if these breakdowns are actually helping you understand this stuff, like this video and subscribe. And share this with someone who's been confused about options. Save them the 3-hour Google rabbit hole. All right, let's quickly recap. A call option is generally a bet that a stock will rise. A put option is generally a bet that a stock will fall. Buying options means paying a premium. Selling options means collecting a premium. Covered calls and cash-secured puts are popular strategies for generating income. And options can be useful, but they come with real risks that beginners need to understand before trading them. You don't need to trade options to build wealth. You really don't. But understanding how they work means you can make informed decisions instead of feeling lost when the topic comes up. The goal is understanding the tools available to you. Nothing more, nothing less. I'll see you in the next video, and until then, keep building your sense and your commas.